All right.
Good afternoon, Pablo.
Good afternoon, Krasimir.
Nice to see you again. I have a chance to talk to you after a couple of months.
That's right. Yeah, pleasure is all mine. I was just checking that last time we spoke, it was on the 28th of March, which is around about 2 months ago.
2.5 months ago, correct? And back then you were relatively bullish. You felt bullish, and you gave us a lot of arguments on the bullish case. Now, for the last 2.5 months, I can give 3, maybe 4 solid counter arguments that make me feel more bearish than I was back then. The first big argument is interest rates. Interest rates, since we spoke last time, have risen significantly, and I mean significantly higher, which makes equities significantly more overvalued relative to bonds. The dividend yield has gone lower relative to long-term yields, so stocks don't pay as well. Second, very much more importantly, bonds have gone, interest rates have gone a whole lot more volatile. Volatility has increased many times over, which means that those risk parity funds have to significantly cut down both bonds, fixed income, as well as stocks, so that's relatively bearish. The third major indicator is exchange rate, currency volatility, and which goes together with currency volatility. So currency volatility has increased both for developed as well as developing countries. And then the last and probably the biggest bearish argument, it could actually be bullish, of course, is the emerging crisis. Many emerging economies are now submerging again and sinking. Of course, closest to our homes will be Argentina and Turkey. So I feel overall a lot more bearish as it is, and I feel a lot more that we don't have a lot more to run in terms of a bull market.
Okay. In terms of what I said last time, if you recall, I had a kind of a differentiated opinion depending on the time frame we're talking about. And I told you back then that on the 28th of March, I was actually quite bearish on the very short term. Okay. So talking about days to weeks.
Yes.
Based on the action that we had in the stock markets, that was quite negative, and basically a lot of the indicators that I followed were pointing at troubles ahead. So I was very careful on the short run, the short term.
Within a month.
Kind of thing. Yeah. And I think that turned out to be truth. So the month of April was indeed very volatile. And May to a lesser extent, but April was a difficult month, so I think that I was right on that one, on being careful. And then I said, well, looking beyond a couple of weeks and up to a month or so, looking into months to quarters, what I would call the medium term, I felt that. So there were lots of things to be very positive about, because the economy in the US in particular, the economy looked like it was firing in all cylinders, so I said basically there is a dichotomy between what the stock market is telling us right now, back then in March, end of March, and what the economy is telling us. One seems to be very positive, the other one seems to be very negative, and that dichotomy will have to resolve one way or the other, and that will resolve in the next month or two. And that is basically what has happened. What we have now is the stock market at pretty much all-time highs.
Close
right?
to, yes.
So the Nasdaq is at all-time highs.
Okay. Uh-huh.
The Russell 2000, that is, if you will, an indicator about the grounds up of the economy in the US, with small companies, small cap companies represented there, also an all-time high, and the S&P 500 and the Dow Jones moving up, not yet in all-time high territories, but moving up, so close to all-time highs. So basically, very bullish action, right? Very bullish stock action, and one thing that is not often talked about, which I consider extremely bullish, is the fact that we have the so-called advance and decline line.
Yes, the breadth
of the market is at an all-time high as well, right?
Okay.
So basically, so that means that if you forget about the market capitalization of companies, if you forget about Apple, which makes up around 10% of the Nasdaq 100 or something like that, and you say Apple counts as one, but a small company counts as one as well,
right.
and you look at who's advancing, who's declining on a day-by-day basis, you see that there is an amazing trend up, where a lot of small companies that don't count in the indices, don't show up in the indices, are moving up, so are showing a very positive price action, right? So that is very bullish, and I think that undermines the strength of the bull market that we have now, and I think that the chances very good that we have that the correction we had between between February and May, that is over. And contrary to the popular say, sell in May and go away, we might very well have very good stock market development during summer. So I don't know. I mean,
that's your expectation.
That's my expectation. If the market behaves in a different way, I'm going to change my mind, right? But the way it's looking now is that it's looking like we are again entering in a new phase of a bull market. My expectation in the midterm is that we haven't seen the euphoria. I mentioned that in the last video.
There is not yet.
We haven't seen the euphoria that typically. So all stock markets die of euphoria, and we haven't seen the euphoria phase yet. So that for me means that that is still ahead of us. It might very well be now in the next 9 months. I don't know. It might be. But if we move into the euphoric phase, that means that we still have another 50% or something of price advances that we can.
So you expect the bullish market within the 6 to 9 month framework, within the next 6 to 9 months, to be mostly up?
Look,
what's the time frame you're talking about? 3 to 6 months,
I think that
9 to 12 months. Where's your time frame?
Yes, I think if looking at both the economic indicators and the stock market indicators that tend to give leading notice of between 6 to 9 months, everything looks, or pretty much, a lot of indicators look very good, right? And that. If they run their course, that would give me confidence to say that everything else being equal, the stock market would do well in the next 9 months. Now, obviously, you have a lot of things going on geopolitically as well.
North Korea.
You have North Korea, you have the Middle East, you have Iran, you have the trade war. You have plenty. You have a president that likes to tweet all the time, and that can, everything can change very, very quickly, and I feel like we are on a position of strength at the moment, so that the economy and the stock market can actually withstand external shocks to the extent that they don't change the outlook in a very negative way. But otherwise, if some exogenous event occurs that changes everything, obviously I'm going to change my mind. But as I said before, everything else being equal, I think that there is a lot to go for a bullish argument over the course of the next 9 months.
6 to 12 months.
Yeah.
Okay. Now, any of these doesn't the rise of interest rates also? We spoke last time. rising interest rates were usually before stocks and bonds were negatively correlated. So when stocks go up, bonds go down and yields go up. Well, recently these have recoupled and become relatively positively correlated, which on a bond stock portfolio 50-50 or 60-40, even though the volatility of the stocks is the same and of the bonds is the same, the volatility of portfolio increases significantly when these are positively correlated. But now bonds, their own volatility has increased and the correlation with stocks has increased. So overall portfolio volatility has increased. Doesn't this concern you that some of these funds that try to maintain constant volatility will have to cut down both on stock purchases and bond purchases?
Yeah, correlation event, right?
Yes, correlation has turned again positive.
Look, I think that is something that basically an accident waiting to happen. Now typically accidents tend not to happen when things look good as they do now. Typically the probability of accidents increases as things start to deteriorate, right? So I mean, an event like that could happen anytime, and I have noticed, by the way, that I've noticed a very interesting correlation that I can't fully explain, but it has happened over and over again, that I think is actually actionable in terms of you can actually make money out of it, and that is, you know that the Federal Reserve Bank is in a period of quantitative tightening now, whereby in the US, whereby they have accumulated treasury bills and notes assets for the last, I don't know, 6-7 years, I don't know how long it was.
So whenever they run these securities off and don't buy back again, and this results in a shrinkage of the balance sheet.
Correct.
During those particular days,
the stock market goes down.
Yes,
and the great thing is that basically the maturity dates of the portfolio of the Fed is public domain, so you can actually access. You can go into their website and check when that's going to happen. The next one, by the way, is on the 30th of June. That's the next event. So if we follow the experience of the last couple of months, the 30th of June is going to be a day where the stock market is going to be negative, right?
Yeah, most likely.
Most likely. Now, I can't explain that. Why? What is the relationship between a bond maturing and not being rolled over and the stock market? There is actually, I don't know, to my knowledge, there is no direct linkage.
The direct linkage is fairly straightforward. Basically, they have to issue new bonds. When they issue new bonds, either the bond price must crash significantly, or some people will sell stocks to buy the bonds. It's usually money flows between the stock and the bond market, so they'll sell some stocks and buy bonds. It's that simple, because we're talking about just a couple of billion in a single day, 3, 5, 10 billion in a single day.
Up to 25, 30
yes,
billion,
up to
25, 30 billion. But that is a drop in the bucket in the context of the stock market.
But as a marginal buyer, as a marginal seller, let's say 10 billion in one day could result in 100 points in the Dow or 50 points in the Nasdaq, and that's exactly what the effect is. That's normal, that's possible. Again, this is the exact opposite of quantitative easing. Whenever the Fed made purchases, the result of the purchases will be boosting both the bond market, but also the stock market. But my point was that the overall level of yields have risen. Now, my understanding is also that overall credit spreads, especially for junk bonds and even for triple double A rated bonds, credit spreads are also rising, which is very negative for the stock market. Or you just say that they've risen but not large enough to put
I think that the expectation of rising interest rates is pretty much priced into the markets. So the Federal Reserve Bank has telegraphed the intention of rate increases very clearly. So the market is fully expecting that there will be a certain number of, I think it's another three this year,
or three this year.
So
short-term raises, but we still don't know what's going to be the effect on the long-term rate. The long-term rate may rise 25, 50, 75, or may not rise at all, and that will further flatten the yield curve.
Yeah, well, again, as I said last time, the big indicator, the king of indicators, obviously, is the yield curve, and thereby not the spread of the yield curve, but the actual inversion is the indicator that has an absolutely fantastic track record in terms of predicting
economics, recessions,
and there is also. There's been a couple of bear markets without a recession, but there have been very few, and those have been very short as well. So I'm less concerned about a bear market that is not undermined or not fueled by a recession. I'm less because history shows that those bear markets are more like corrections that you can ride.
They're not right through. They're not as devastating.
Correct. Okay. But for that reason, I pay a lot of attention to the inversion of the yield curve, and the yield curve has been narrowing, but is way.
It's not yet inverted. So at the current speed of inversion, it will take 6 to 12 months before it inverts.
Yeah.
In a sense, these are the 6 to 12 months that it will give you the time where the stock market could still go.
From the minute of the inversion, you still have 6 to 12 months until the recession begins, right?
Correct.
And then the stock market would discount that back 6 months.
6 months.
So you still have
8-10 months.
A significant amount of time to accommodate to that expectation, right? So I think that yes, that is a concern that interest rates are going up, but inflation is also going up, right? And remember,
inflation is going up.
And remember,
oil has been going up.
Remember that inflation, the first phase of inflation from going from low to slightly higher levels, not yet high inflation, to moderate levels, that's actually very positive.
Correct.
It feels very good. It feels very good. Wages are going up. People have more money in their pocket. Companies are doing well. They can increase their prices. So the first phase of inflation feels very well, and it's positive for the stock market.
Everybody wins and no one loses.
What happens eventually is that inflation destroys the economy, right? But that we're very far away from that point now.
Yeah.
We are kind of in that sweet spot, this Goldilocks situation where you have increasing inflation that still feels good, right? So I'm less concerned about that. I'm not fully discounting that potentially will become an issue, because the Federal Reserve Bank has had a track record of basically tightening until they've driven the economy to recession. Right?
Yeah, something breaks.
So basically until something breaks, they tighten until something breaks, and so that I'm concerned about that. But I think that we still have a Goldilocks period where
6 to 9 months where nothing terrible will happen.
Yeah.
So you're talking about events like Deutsche Bank. Some people say the event has already happened. It's already more or less installed. They try to figure out how to unwind it. You're concerned about Deutsche Bank, or again the same story, not within the next 6 to 9 months?
Look, at some point, I will seriously consider buying shares in Deutsche Bank, because I think that there is a price for everything. And even though Deutsche Bank is probably not the best bank in the world, and it has a lot of issues, at some point the price will have everything priced in, all the issues priced in and more, so that basically the stock will potentially be a bargain, even though the bank is still a trouble bank, right?
Right.
And one thing I can tell you, Deutsche Bank is not, I repeat, not going to go bust, because
they will not let it go.
They will not let it go bust.
Right. Because it's the biggest and most systemic bank in the world. You know, if it goes bust, this means the whole financial system will implode, and they'll never let that happen.
Yeah.
Okay. Now, what about emerging economies? Probably the biggest monster out there is Turkey. Turkey is by far biggest. We're talking about trillions. Again, even bigger is Italy. I mean, Italy is way bigger than even Turkey. Italy is one of the top 10 biggest countries in the world, 10 biggest economies in the world. They got way over $1 trillion of government debt. They got one of the highest, second or third highest debt in the world after Japan and Greece. I mean, Italy is also on the brink of collapse. Turkey is pretty much on the brink of collapse. Of course, you know a lot more about Argentina. Do you think that we may get hit a lot sooner with an emerging crisis? Well, just recently, just a couple of days ago, there was an outcry from, the Malaysian central bank. They want the Fed to slow down the quantitative tightening. Yesterday or the other day was from Indonesia. And of course, the Indian central bank, the governor again reminded guys, hey, you're going too fast. You shouldn't, reduce the balance sheet. In other words, you get to see almost everywhere what they call them now, the baits, Brazil, Argentina, whatever, Italy or Spain, right? T will be Turkey. So you got all of these countries. They're pretty much just a matter of collapsing. Now, with this, I guess this will completely change your thesis, or the thesis will be, they're at risk, but they're not going to collapse within the next 3 or 6 months.
Well, look, I have my opinions, but as I've been saying all this time, the stock market has this habit of not paying attention to my opinions. And I basically submit to King's stock market. If the stock market proves me wrong, I'm going to be the first one to change my mind, right? And I think that a systemic emerging market crisis, emerging or accelerating, is something that will possibly have implications on the stock markets, on the U.S. stock market as well. But and I think that we're going to do a separate video on emerging markets specifically. But just to comment in relationships to the stock market in particular, if you look at what happened in the emerging markets over the last month or so, Argentina went through basically a bear market. The currency collapsed 20%. Turkey, the lira has been falling like there's no tomorrow, and Brazil, the real has fallen significantly as well. The stock market also has fallen more than 20%, and Italy went through its own mini crisis with the yields going from negative to I don't know how high, and yet we have stock markets in the US that are at all-time highs. Breadth at all-time highs. So it seems like actually
the stock market is ignoring all this.
Doesn't care about it, right? And it's like eating all these things and burping it out, and it's not
until the next Lehman, right?
Well,
or until the next Thailand, like the Asian financial crisis in '97. Or see, you're going to say, oh, well, even in August 97, the Asian crisis came in Thailand, and then the next month was Indonesia and Malaysia, and still the US stock market got hit in 98, a year later.
Yeah.
So what you're saying is that, well, even though you have an emerging crisis brewing, it may take 6-12 months before it, the stock market finally buckles.
No, I mean it depends on whether that crisis materializes or not, right? I think that
well, it will materialize. That's pretty much the sure thing. The question is what's the speed.
That's your opinion, but it's up for debate, Krasimir, because arguably the one thing that has the highest correlation with emerging market crisis is a costly dollar. Or a significant increase in the dollar exchange rate versus emerging market currencies.
It's actually both rising dollar interest rates and rising dollar exchange rate, which usually go hand in hand. And when they both rise, suddenly this chokes all of those indebted.
But you say that they usually go hand in hand, and there are theories that speak for that argument. But if you look at what happened throughout 2017, basically the interest rates in the US were going up already, and expectations of interest rates were clearly pointing up, yet the dollar went down significantly. And why didn't we have any any emerging market crisis last year?
Yeah.
Because the dollar was weakening all the year.
Correct.
Pretty much all of the year. And now, since we have a little bit of a rebound, all of a sudden the countries that were most
indebted, dollar indebted,
or that had some kind of weakness, systemic weakness, they became the victims of the rebound of the dollar. Now, what's going to happen with the dollar going forward, right? So for me, that is the key. If the dollar continues shooting up as it has over the last 3 months, right? Up to 2 weeks ago, when it flipped down again, right?
It peaked at 95, yes.
Something like that. But if you look at some emerging market currencies, they have throughout 2017, the currencies like the ruble, for instance, have gone up significantly, or the dollar has gone down significantly. The Argentinian peso, the Brazilian real were both quite stable vis-a-vis the dollar, in spite of domestic inflation. And so I think that the dollar, the curse of the dollar, if the dollar goes up or down, that's going to determine whether the crisis in the emerging market is going to disappear and we're going to forget about it, and it's going to be like, oh, it was just a bad nightmare, and we're now back to normal.
Like the European financial crisis in 11, 12 to 2012. It was bad, it was horrible, everything's going to collapse, and then Mario Draghi said he'll do whatever it takes, and it's all forgotten now. So maybe what you're saying is we can go through this bad phase without evolving and really causing it.
And so if we don't have a major debacle in a significant economy in the world, I think that or other geopolitical unexpected exogenous events, I think that the stock market is going to digest all these minor things without any problem and keep on rocking up, right?
Well, keep in mind that we don't need a significant. Thailand was not a significant. Americans were very clear. We are not going to bail out Thailand in '97 because Thailand was too tiny and it was recognized as insignificant. But then we rolled over to the next country and then to the third.
Arguably, back then, so you didn't have the kind of banking regulation for systemically important financial institutions that you have today. So basically, back in those days,
especially
banks would be very involved in speculating directly with assets, which large banks today are prevented from doing, right?
Except Deutsche Bank, because they are the biggest derivatives trader in the world, right? Bigger than JP Morgan. They got more, what is it, 300, whatever, some kind of monstrous amount of. But anyway, okay.
Yeah. So my view is that the dollar has had a rebound now and will continue its march lower, or will at least stabilize in the trading range.
So they'll get a reprieve for a while, 3-6 months probably. The dollar isn't going to bother them unless the Fed just keeps raising and raising.
Which I don't think that's going to happen, given the conflict, the intrinsic conflict of interest that you have in central banking. In the US in particular, but others as well, to keep the economy growing basically, and hence to keep the unemployment low. So by having this dual mandate of controlling inflation and keeping unemployment at a minimum level, that is basically a conflict of interest, right? And when it comes, that's different. It used to be different with the German Bundesbank that had just one objective, which was to fight inflation, right?
Right, price stability.
So basically, a central bank that has to create economic growth in order to secure the minimum possible unemployment rate, you have the most important player in the financial markets basically out there with the job of making sure that things don't fall apart. Right?
So they're pro-inflationary, and that's mostly weakening the dollar in that sense?
Correct, yeah.
Okay.
So now obviously I don't claim to be able to predict movements in currencies. Currency trading is probably the most difficult and most unpredictable thing there is, because it's not only just one. You're not assessing the quality of one currency, but you're assessing the quality of that currency in relationship to other currencies, because currencies obviously float against each other, right? So it's all a matter of relativity. It's all a question of how good or how bad you are in relationship to not absolutely, right? Whether you are good or you are
sync. They're
all syncing together at different rates, right?
Correct. So which syncs faster? Okay. Yeah, I understand. So basically, if you can summarize from what I'm hearing or understanding, is that your generally bullish thesis remains relatively unchanged or more or less confirmed, and that the major developments that I mentioned in terms of interest rates volatility, interest rates level, currency volatility, for the moment currency level of the dollar, that in the emerging crisis, currently none of these is significant enough to change
to derail.
To change your midterm 6 to 12 months stock market bullish perspective.
That at some point in the future, after this 6 to 9 to 12 months, we're gonna have a very boring debate, because I'm gonna be fully on your side, and I'm gonna be defending the bearish argument. I do think that we are, the way things are going, at some point there's going to be a big crisis that is going to potentially be very big as well.
Very big.
So when that is going to happen, I don't know. I think that it's beyond my trading horizon. So for the time being, I'm not focused on that. But if and when things develop in that direction, I will be fully on your side.
Now, do you feel like we're climbing a wall of worry, or not quite, or it's about wall of worry, or people are relatively optimistic without euphoric?
Exactly. So if you look at sentiment indicators in the stock market in the US, they have gone to a significantly bearish stance over the period between February and April or so.
So the euphoria has...
whatever was there perhaps was starting to come up in December, January, the animal spirits coming out of the caves, that got killed in February, March, April. And now the bullish indicators are starting to go up.
Okay.
Rightly so, because the markets are behaving very bullish. So, but we are in a very kind of neutral territory where we are far away from being euphoric
and not quite optimistic, but certainly not a wall of water, kind of like in between.
Yeah, in between.
Okay. Well, thank you very much.
Thank you.
I appreciate
It was a pleasure.
the interview.